Hello, everyone, and welcome to today's webinar on market insights for fixed income, where we will explore the key trends and opportunities shaping the fixed income landscape. As widely anticipated, the Reserve Bank of India's Monetary Policy Committee on February 8th decided to cut the policy rate by 25 basis points to 6.25%. However, the policy stance remains unchanged to neutral, and this decision was taken unanimously. I am Sandeep Solanki, product specialist, and I'm joined by Mr. Anurag Mittal, our head of fixed income, to provide you a deeper understanding of current market dynamics and share his insights on fixed income market. After Anurag's presentation, we will open the floor for Q&A session. Please feel free to submit your questions via link provided throughout the webinar. Without further ado, let's dive right in. Anurag, over to you.
Thanks, Sandeep, and good day, everyone, and thanks for joining in at the Fixed Income webinar. So as Sandeep mentioned, we'll be discussing the RBI policy update and other key global trends which should shape the fixed income market and the right products which we can consider as per our view. So starting with the global trends. So broadly, if we see, the left chart represents the manufacturing as well as services PMI, across the globe, and the right side is specific to the Asia, ex-Japan, and China. The dark line and the red line is the developed markets PMI, which is the composite PMI. So broadly, if we really see the trends, they're getting quite interesting in 2024. So for most of 2024, we saw manufacturing being on the lower side. It was below 50, which represents a marginal contraction, whereas services remained quite healthy. And in fact, for the last 2 years, they have remained above 50, which is, expansion zone. But if we see the end of 2024 and the beginning of 2025 now, services have started to decline after 2 years of a strong outperformance, but manufacturing has started to inch up, since November 24, and now, in fact, last month it was above 50. And what's really driving is we discussed it in the last two webinars that even when President Trump had come in 2016, the next 12 months were actually quite strong for manufacturing because manufacturers and importers, in anticipation of tariff, had started to ramp up production and started to ship those goods to the US. And that's what largely, so before the tariffs came in, because of the anticipation, there was a sudden spurt in manufacturing, and that's what seems to be happening at this point of time as well, because as importers were anticipating President Trump victory, and when the victory was declared in November of 2024, and that is the time before tariffs get announced, we saw some ramp up in manufacturing, especially after a low base in early 24. Western Europe, led by Germany, France, etc., seemed to be doing reasonably well from its 2023 and 24 lows. Of course, emerging markets, they continue to do well as well. Largely, what we saw was that in the September and October periods of last month, when China announced its monetary and fiscal stimulus, we saw a sudden pickup in activity in China, and now that's kind of flatlining. So broadly, if you see what segments are and sectors are doing well, it's emerging markets, and broadly it's developed markets led by the US. And if we see the composite PMI, the red line on the right side of the chart, it seems to be indicating the same, where we see that it's picking up at the end, which is the fag end of 24 and beginning of 25. The same is getting reflected in headline PMI for Asia, ex-Japan, and China. So overall, while growth may not really pick up materially globally from these levels, but as of now, it's sustaining quite well, and we do expect growth in the near term, at least, to maintain the current run rate. Coming to commodity prices, so if you see, the Bloomberg Commodity Index on the left-hand side, it saw a pickup in, in last month, broadly, led by a secular rise in gold, silver, copper, and other industrial metals. Of course, crude, because of excess supply, has remained soft. So broadly, what we saw the trend is that commodities, especially the metals, are continuing to do well. Energy prices, as of now, remain range bound. We will need to see how the industrial cycle picks up going forward. But so broadly, what we saw on the first slide, that manufacturing is doing well, and that's also leading to pick up in industrial metal prices. So we need to see sustenance of strong manufacturing activity to also see this continuous pickup in metal prices as well. Probably at some point of time, as global growth slows down, these metal prices should also stabilize at some point of time. If we look at the food index, and if we so while it picked up in 24, but overall, if we look at 2024 as an average, they were actually lower than 2023, because what we had was, yes, we had pickup in sugar and cereal prices globally because of changing weather patterns. We also saw decline in vegetable oils, dairy, and meat products, which overall led the food index for 2024 as a whole lower than 2023. Of course, we will need to see how monsoon pans out for India and other parts of the world this year to really assess food prices. But yes, given the changing weather patterns, food prices are likely to become an important variable in central bank policy making in 2025 as well. We talked about tariffs in slide 1, and what we saw this time from President Trump in 25, and which is quite in contrast to his previous term. So in previous term, he was elected in November 16. He assumed office on 20th January 17. And of course, being the first term, it took some time for the US administration to identify the countries they want to put tariffs on, the goods they want to put tariffs on. So the actual tariff announcements came almost at the end of 2017. So while there was a lot of noise about tariffs, but the actual impact started to affect the global economy by the end of, almost 1 year post President Trump's election as the US president. If you see the contrast to the situation today, just after assuming presidency, because of the strong mandate, President was able to announce tariffs on Mexico, China, and Canada. And of course, these have now been postponed for a month, but the China tariffs still stand. So broadly, because of the strong mandate and because the playbook is almost there, the tariff announcement could come up early part of the administration. So the impact if these tariffs were to actually happen would be about 0.7% on US core PCE. Mind you, the Federal Reserve tracks PCE and not the headline inflation, and there will be a negative impact of 0.4% to US GDP if these tariffs were to come. For now, because of certain promises made by Mexico and Canada, those tariffs have right now been paused. The second part, which also was announced by the US, was there was a de minimis exemption of goods up to $800 of imports into the US. So, for example, if you were importing of something like 700, 600, any small item from a Chinese e-commerce company into the US, that was exempt from custom duty. So the US has also removed that exemption, which should largely affect China going forward. So that we will need to continue to see that how it really impacts, especially the e-commerce related shipments. So what's happening because of that is we can see on the right hand side chart, which is the currency performance of major emerging market and even the developed market currencies against the dollar because of the uncertainty and tariffs, etc. Largely, if you see since October 24 is when really the financial market started to price in the change in US administration, and we see till January end, most of the currencies have depreciated. Of course, currencies which are more sensitive to commodity prices, more sensitive to exports, they have depreciated much sharply, like your South Korean won, Turkish lira, Indonesian rupee, etc. Currencies like India, for example, have depreciated much lesser because their export sensitivity is relatively lower. Of course, Chinese RMB is also partially managed, and that's why we are seeing relative stability in the Chinese RMB compared to the rest of the world. Of course, because of the slowdown in China, the RMB had been on a depreciating trend for the last 2 years. So there's also some amount of catch up which is happening in the other emerging market currencies, because largely when President Trump was supposed to come, the initial impact was supposed to be felt mostly on China and Mexico. But what we are seeing is it's probably happening at across the major exporters to the US. So for example, Mexico represents about 15% of imports to the US, similar of China. In fact, more than China. If you look at Canada, also it's almost similar to China. So it can be quite significant and may not just be limited to China. If we look at inflation, so notwithstanding the impact of these tariffs on the US economy so far, broadly, inflation continues to stabilize. They are nearing the pre-pandemic run rates. However, expecting monetary easing to be quite gradual, as most of the rate cuts have started to materialize in 2024 itself, and event risks like tariff and trade wars have increased, which will slow down many. We still think the long-term, action on policy rates will be more determined by inflation growth trade-off rather than just about tariffs and other event risks. But in the near term, at least, these event risks will weigh on many central banks, especially which are more exposed in the way to US economy. Of course, central banks in the emerging markets like India, Indonesia, etc., they have a delicate balance to maintain while the domestic economy is slowing down, and for that they may need to cut policy rates, but at the same time they will be mindful of the currency pressure. So as we saw in the previous slide, EM currencies are depreciating against the US, so they have to be mindful that they do not cut rates very aggressively to ensure that their domestic currency also remains stable in these volatile times. So we saw broadly how sovereign bond yields globally behaved. So largely, if we see a very interesting chart, especially for interest data for the US, the last year US started with the 10-year rates being at 388, and despite all the rate cuts that we saw in the last year from the US, in fact, the US 10-year yields are higher than when they started last year. If we saw the same goes for the UK, which has seen rate cuts, the same goes for Germany as well, which has seen rate cuts. China has been the most exceptional performer when it comes to bond, which has seen its yield going from 2.56 to 1.63 now because of the slowdown that they're experiencing in the domestic growth, as well as reducing inflation. Broadly, for the month of January 2025, what we saw was some amount of value buying, which was emerging due to yields, spiking up quite sharply in December 24. We will need to see continuation of slowdown in inflation and minimization of event risk to see further rally in bonds. We do expect that probably, at least in the near term, bonds may remain range bound globally till market participants get a sense of central bank reaction function, that how many rate cuts are probably expected, especially from the Federal Reserve going ahead. Right now, markets are just pricing 2 rate cuts from the Federal Reserve. So if that expectation were to materially change because of improving inflation or probably some slowdown in growth, that is when we could see some rally in global bond yields. So coming to domestic economy right now, update on the RBI policy. Overall, the expectations before the policy were running quite high. One of the main reasons for RBI holding out on cutting rates has been higher inflation. So as we see, in December 24, the Q3 inflation forecast by RBI was put out at 5.7%, which was at the upper end of RBI's 4% plus minus 2 target. Which, if we see now, finally RBI is getting decent amount of confidence on the decline in inflation, largely due to normalization of vegetable prices. So next year, RBI is expecting around 4.2% headline inflation, which is broadly in line with market estimate, which is also expecting inflation to be in a similar range of 4.2 to 4.5%. So before the policy, there were expectations that because of the overall decline in inflation next year, RBI could be more dovish. Secondly, what we saw also was an acknowledgement that probably next year growth may be moderating, especially coming from the budget as well as from economic survey, that probably compared to the earlier estimate of 7% plus growth may moderate to around 6.3 to 6.8% real GDP growth for FY26 as per the economic survey. And thirdly, in the budget, overall what we saw was good amount of consolidation. Even for FY25, government, is expected to print 4.8% fiscal deficit compared to the initial budget forecast of 4.9. Even for next year, government has estimated about a 4.4% fiscal deficit, which was lower than market expectation. So overall, if you look at all the triggers which could determine RBI policy, we had forecast of lower inflation, we had forecast of lower growth, and we also had a very responsible fiscal policy. So the expectations were running quite high that not only will RBI cut rates, probably they will do more on liquidity measures, or they may signal a deeper rate cuts going ahead by changing the stance to neutral. What we saw in the policy was that the policy was very steady, very stable. It was largely in a continuation of what we have seen, from the RBI in the last 6 months, despite the change in leadership. So in October, if you remember, RBI pivoted their monetary policy stance from withdrawal of accommodation to neutral. In December policy, they maintained the stance at neutral, but they cut the CRR by 50 basis points, and they injected about 1.16 lakh crores of liquidity in the banking system. And if you look at the third step, which is typically in a monetary easing cycle, which is the first step is change of stance. The second step was liquidity injection. And if you look at the third step, which was the change in or the cut in policy rate. So largely, despite the change in leadership, the RBI policy has been very well sequenced and very logical and very, very, I would say, steady basis. As far as the liquidity, expectations that market was expecting that RBI will do something on the liquidity part. If we see so far after the CRR cut as well, RBI has announced FX buy-sell swap auctions of 5 billion. RBI has announced 60,000 crores of OMO bond buybacks, and RBI has also announced a 56-day VRR about 50,000 crores. So collectively, these steps were adding about 1.6 trillion rupees liquidity into the banking system. So we do expect that RBI will continue to add to liquidity. They will continue to proactively manage liquidity to ensure that the call rate is aligned to the policy or the repo rate in this case. So broadly, while RBI did not address liquidity directly in the policy, but if you look at their actions, which are more important, their actions have been quite in the direction of improving systemic liquidity. So we are not too concerned. We still think that liquidity is a priority for the RBI. Second, we still think that there are still more additional rate cuts in the offing. So while we do expect a 25 basis cut in the next April policy, the next 25 basis cut after the April will also depend on how the evolving growth and inflation dynamic starts to pan out. Because mind you, RBI is already projecting a 4.2% inflation for FY26. So for inflation to go down from 4.2%, it may be slightly difficult. But if you look at the growth forecast that RBI has made, it's at 6.7% compared to the economic survey forecast, which was between 6.3 to 6.8. So the actual growth forecast, if we see, is on the upper end of the government's or Ministry of Finance growth estimate. So we do think that in case growth were to surprise on the downside from the current 6.7% and inflation remains stable, probably RBI may cut the additional 25 basis. So that 25 basis probably lasts as a judgment call. But all in all, we are expecting a total 50 to 75 basis rate cuts during the current monetary easing cycle, out of which 25 has already happened. We do expect RBI to continue with the liquidity enhancing measures. So overall, what segments make sense in this monetary policy cycle, we will discuss at later stage with other indicators which are also equally important. So broadly, just to update on how inflation is likely to pan out. So, like we as we are seeing, overall inflation is continuing its softening trend. The December inflation declined from 5.5% in November to 5.2% in December. Broadly, the main culprit in rise in inflation was the food basket, especially vegetables. The main factor behind the decline in inflation is also, vegetables and other food prices. So it's as winter has set in, food arrivals has improved, and that's largely leading to correction in food prices and the decline in inflation. So if you see the CPI diffusion index, which is the weight of constituents, which is showing higher than 5% inflation, that's largely been stable, although it's picked up since mid of 2024, but it's not really picked up materially. Largely, it has been around 30%. So about 70% of items approximately still are showing lower inflation than 5%. So overall, inflation continues to be quite well managed. In fact, if we look at core inflation, which came at 3.6%, below the November print of 3.7%. So, that also shows that overall economic activity and demand continues to be on the softer side. So if we really strip out, fruits and vegetables, probably inflation is quite moderate and quite healthy. And if food arrivals and weather pattern continues to be normal, probably next year we should see moderate inflation. So if we look at the liquidity conditions, we talked about how RBI has been injecting, liquidity. So average liquidity deficit in January 25 had shot up from 62,000 crores deficit in December to almost 2 trillion due to overall tax-related outflows and currency leakage. Mind you, in the Jan to March quarter, typically government spending becomes quite erratic. As they want to preserve that fiscal flexibility, and typically funds are released in end of March and April, and hence temporary liquidity becomes tight, and that's what's happening in the current January month as well. But RBI has announced various measures to infuse liquidity, and we do expect money market curve to remain quite stable going ahead, as RBI continues to inject further liquidity into the banking system as well. So we look at credit deposit growth. The second, factor which really makes us more constructive on money market or the short-end rates is this now shrinking credit deposit gap. So we see, especially in the 2024 and 23 period, there was a very significant gap between your non-food credit growth, which is your green line, and the blue line, which was your deposit growth. And if we see in the last 4 months, as RBI had tightened various measures on personal loans and unsecured credit, we've seen that gap really, shrinking. So for example, if you look at unsecured loan growth, has fallen to 10.5% from 13.1% in November 24, and personal loan growth has in fact decelerated to below 10%. So that's largely leading to credit growth going slower. That also means that banks have a relatively better share of deposits, and the credit deposit ratios are improving, and probably they will not need to raise deposits at very aggressive levels, and that's largely makes us more constructive on money market rates as well. So if we look at the fiscal trend, of course, we have discussed budget in quite greater detail in our previous policy. But if you look at broadly the trend which gave that confidence to the government to run a lower fiscal deficit in FY25 as well. So if we look at capital expenditure, overall YOY basis till December, it was just 1.5% growth because the first 3 months the expenditure was quite low. So because of savings on that expenditure trend, government was able to manage fiscal year 2025 quite well. If you look at the tax collections, the corporate tax collections, which were on the lower side, they rose about 10.5% in December. And of course, personal income tax collections have been quite strong as well. So broadly, we do expect this picture to continue in FY26 as well. So we are quite constructive, at least from a bond demand supply dynamics, at least in the near to medium term. On the trade account or the trade deficit improved from 33 billion almost in November 24 to 21.9 billion in December 24. One of the main reasons for the spike in trade deficit in November was gold imports, as we can see, which moved from 3 billion to 9.8 billion. So about 7 billion delta came from November 24. From gold imports. And broadly, we see what's happening in December is that gold imports, which was a seasonal one-off effect, is normalizing, and that's largely linked to the improvement in trade numbers. If you look at non-oil exports as well, they improved from 28.4 billion to 33.1 billion. And in fact, one of the biggest contributors of this non-oil exports has been electronic segment, which is benefiting from the various PLI measures that the government has taken in the last 2 years. So overall, non-oil export number is quite healthy. So we do expect CAD to remain quite manageable for FY25 and even for FY26. What really could lead to depreciation pressure on currency would be the FPI outflows that we have been seeing on the equity side. Probably the BOP surplus that typically India maintains could shrink meaningfully in FY25 and FY26, and that could largely lead to some amount of INR depreciation. But as we saw in one of the previous slides, INR depreciation has been relatively quite better than other emerging markets. So as long as we believe that we are doing better than other emerging markets, we are quite comfortable, and we don't think RBI will have too much of a worry if rupee depreciates, as long as relatively we are doing better than other emerging markets. If we look at the sovereign curve, mostly the yields declined in the month of January in the run-up to the budget, as well as to the RBI policy. Like we said in our update on the RBI policy, there were a lot of expectations that RBI will probably announce some liquidity measures, or they may change the stance, etc. And hence we saw some rally on the top of the rally that we saw in December 24. So, like we said, the rally was quite broad-based. So, whether we look at T-bill curve, AAA curve, or AA rate, rates, they all fell, from December to January. So, whether we look at 5-year, 10-year, etc. So, broadly, the rally was, quite broad-based. We think going forward, probably the 1 to 5-year rates should outperform the 10-year yield levels. What it really means for investors. So what we have tried to say throughout our presentation is that globally growth is quite stable. Your inflation is going back to the pre-pandemic run rate, but your event risk in terms of the tariff issues or trade wars have increased, which will keep central banks slightly uh, cautious, and probably will may not lead to aggressive easing cycles unless and until growth impulses really go down meaningfully. For what India it means is that given that we are already expecting inflation close to 4.2%, we will need a meaningful downward surprise on growth to cut rates more than the current market expectations of 50 to 75 basis points. And given that we are expecting a shallow rate cut cycle, we believe that a moderate duration products, that basically means that products which invest up to 5 years weighted average duration in their portfolio, that provide the best risk reward in this scenario of shallow rate cut cycle. Uh, other couple of other factors which are also positive, I would say, for intermediate duration. One is that RBI has been quite proactive on liquidity, so they are likely to keep liquidity on the easier side. They are likely to keep overnight rates close to the policy rate, which are quite constructive for the shorter end. Secondly, one of the major concerns of the banking system that was that the LCR guidelines, which would have required them to keep, higher LCR assets or the HQLA assets compared to the fixed deposits, and that probably would have led to higher demand for government bonds as well, because they need to keep higher HQLA assets, but that would have also led to us, a larger issuance of CDs. So as the RBI governor said in the policy that they are likely to defer LCR guidelines from April 25 to at least March 26, that gives further leg to the moderate duration rally, as the pressure on CD issuance will also be lower. So, what it really means for investors is that if we have a up to 12 months kind of investment horizon, probably low duration and money market strategies make more sense for us. If we have a more than 12 months investment horizon plus some appetite for mark to market volatility, probably moderate duration products which run between 1 to 4 year weighted average duration, such as short-term fund, banking, PSU, corporate bond funds, etc. They make some sense for the investors, given that they are also right now offering attractive accrual, and also there are prospects of mark-to-market gains in these strategies as the monetary easing cycle unfolds. So that's largely from my side. I would request Sandeep to open the floor to questions, and happy to take all the doubts on the webinar or any other doubts that we would have on RBI policy or on the budget. Thank you.
Thank you. Thank you, Anurag, for your valuable insights. Let's move on to questions we have received. So the first question is that you have noticed that the bond market reacted with some disappointment following the policy announcements. So, Anurag, what do you think was the key reason for this, and how do you see the market evolving going forward?
So, like we discussed, during the RBI policy update, was that market was coming to the policy with a lot of expectations that probably RBI will be changing the stance in the policy, or RBI may announce more OMO bond buybacks in the policy. And that's why the market positioning was quite heavy in the run-up to the policy. But what we saw in the policy was a very steady performance by the RBI, that they did cut the policy rate by 25 basis points, which was also expected by the market, but they did not announce any new measures, as they have been announcing measures on liquidity or other measures also outside the policy. So we did not see any reason for them to announce new measures in the policy. But I think that was one of the reasons for market participants to probably feel a bit disappointed, and there was some profit booking which happened because of the very heavy positioning. But from a steady state and a more sustainable perspective, if we believe that we are expecting rate cuts, nevertheless, we do think the valuations are still quite constructive, and we should see further rally. So it was probably one-off episodic, some profit booking that we saw, but we do not think that one should judge the market dynamics by one-day reaction. Overall, the direction of rates and direction of policy rates is heading lower as we move along in the next 3 to 6 months.
Very well answered. So the next question is, given that this was the RBI's first move after a long period, can we interpret this as a prioritization of growth over inflation? How do you see, or how do you view the balance between the growth and inflation in terms of real interest rates going forward?
So I think, as the governor also alluded in the RBI policy, that the primary objective or the primary mandate of RBI, as has been given to RBI by the Parliament, is headline inflation of 4% plus minus 2% to respond to exceptional events. But the primary mandate of RBI has been, since inflation targeting has been introduced in 2016, has been inflation, and with the objective of supporting growth. So I think that continues despite the change in leadership. So that I would expect that RBI focus will remain on inflation management. I think the rate cut, as even the governor said, is because of more favorable inflation growth dynamics. So if you see inflation, how it has behaved in the last 12 months, inflation has been around close to, on an average, about 5.5%. Next year, the same inflation, because of better base and overall lower food prices, is expected to be close to 4.5%. So overall decline in inflation has been more, or the expected decline in inflation is more than 100 basis points. At the same time, if you look at growth is coming from a base of 7% plus in the last 3 years, now to below 7 and around 6.5% in FY26 as well. So from an inflation growth dynamic perspective, what had really happened was inflation had fallen off quite sharply, or the inflation is expected to fall quite sharply, and growth is also expected to moderate. So I think that is what gave confidence to RBI to cut policy rates, that given the decline in inflation and as well as the moderation in growth, they can cut policy rate. But I don't think that RBI is trying to support growth on the cost of inflation. So just to give it in a very simple manner, if inflation was at 5.5 and growth was declining to, let's say, 6.5, will RBI cut rates? I don't think so. But because they have the visibility that inflation is going towards 4.5, and at the same time growth is moderating, that gave them some policy space to cut interest rates.
This is really interesting insight. So the next question is, inflationary pressures could arise due to the factors like heat waves in the coming months. So do you think this could pose a risk to the growth prospects the RBI is targeting?
So it will lead to risk to both growth as well as to inflation forecast. Of course, if there are heat waves and there is destruction of food crops, it may lead to a multi-pronged impact. One is on the rural incomes, which may see some decline. It may also lead to higher fiscal deficit, because as the government may have to announce some welfare measures to kind of support the rural community. And at the same time, from a growth as well as inflation dynamics, it may lead to sudden volatility in inflation, which may pause RBI easing cycle. So that is something which I think RBI or the government will be monitoring and watching. So that always remains a risk in a country like India, where about 45% of current inflation basket is food related. So any such event could be something to watch out for, and that is why we said that the policy cycle is 50 to 75 basis points, because those risks could remain. And especially post June of this year, both the government and RBI will be watching the behavior of monsoon, that how monsoon pans out for 25, and the outlook for food inflation going ahead as well.
Interesting. Again, the next question is related to inflation. Now, with 1 trillion tax, the tax cut announced by the budget, if this leads to higher consumption, what would be the potential impact on inflation?
So I think there are two sides to this tax cut. So one, if you see, various RBI study also, there has been reduction in overall household savings. And if we divide the households by income strata, borrowers which have been earning between 5 to 15 lakh have seen one of the biggest jumps in household leverage in the past 3 years. So what it really means is also that some of the households have been borrowing just to maintain or sustain their their livelihood. And so the tax cut should not be assumed that it will all lead to consumption. So while a large part of that tax cut uh, probably will be utilized in consumption, but some amount of that tax cut will also be utilized to reduce that household leverage. So probably the inflationary impact of this tax cut will not be very, very high or very material. Secondly, like we saw when we were discussing inflation, that core inflation is still running at 3.6%. So that also signifies a certain softer demand in the economy. So so given that some of this tax cut will be used to deleverage, and even if let's say some of it will be used to boost consumption, we do not really see major pickup in core inflation because of the tax cut.
So the next question is, the budget has forecasted around a 14.4% growth in the income tax revenue, despite the substantial tax deductions. Do you see any risk that the target may not be met?
So the budget has assumed a certain amount of security transaction tax and capital gain tax as well, apart from the rise in personal income tax. So if let's say market activity were to remain subdued or get subdued, and markets performance also may be slightly worse than expected, then probably we may see some slowdown in income tax collections for FY26. However, I think it's too early to say that even if there was lower tax collections on the income tax side, it may upset the fiscal balance for government, because government has levers to pull on the other revenue expenditure items or capital expenditure items. So we think that government should be able to manage overall fiscal by reducing expenditure if they see some loss of revenue because of income tax collections.
The next question is, how are you adjusting the duration of your portfolio in response to the RBI's rate cut? And what's your outlook on the long-term bonds versus short-term debt instruments?
So our portfolios were positioned before the RBI policy and before the budget for a shallow rate cut cycle. They are still positioned for a shallow rate cut cycle. So broadly, our portfolio positioning has remained quite consistent, I would say, for the last 6 to 9 months. As far as the performance of long bonds versus short bonds. So when I say short bonds, probably I would define short bonds as something maturing up to 3 years, and long bonds something probably maturing more than 15 years. And if I were to compare these two, I think while the demand supply dynamics of long bonds is quite favorable because of the rise of long-term investors such as pension fund, insurance products, etc., have ensured that long bonds remain quite stable. But from a risk-reward perspective, I would say the probability of outperformance in short bonds, that is, with bonds maturing up to 3 years, is slightly higher than long bonds because of 3 reasons. One, the rate cut cycle is expected to be shallow. So in shallow rate cut cycle, typically is the shorter end which performs rather than the longer end, because the forward rate expectations of market are quite muted. Secondly, if we see the RBI actions, RBI has been injecting liquidity, and probably by April and May of this year, we will see high amount of government spending, as well as when RBI pays a dividend to the government of India in about May 25, that will also create liquidity. So overall liquidity position should be quite healthy, which is quite constructive for short-term bonds. And the third, which I said, was the deferment of our LCR guidelines, which will also reduce the pressure on banks to issue CDs very aggressively. So all the 3 regulatory plus policy measures, if we put together, is much more constructive for short-term bonds rather than long-term bonds from a risk-reward perspective. So when I say risk-reward, I means basically whenever we take any portfolio decision, we are playing in probability. So what we are basically saying is that the probability in this strategy is slightly more favorable than the probability in the long bond strategy. In what kind of scenarios will a long bond outperform? A long bond may outperform if the rate cut cycle turns out to be much deeper than expected. So right now, like I said, we are expecting 50 to 75 basis. So if the rate cut cycle turns out to be quite deeper because of, let's say, a slowdown in growth or collapse in inflation, probably long bond may do well. If the government were to reduce its fiscal deficit even below 4.4%, what they've indicated for FY26, and the government borrowing were to reduce, probably long bonds could do well. Right now, if you look at the probability, we think that government has already taken a lot of fiscal adjustment. We do not see material downside in the fiscal deficit from 4.4%. Similarly, we still think that growth, while it has moderated to around 6.5%, it's still quite respectable number. And we are, unless and until there's a major growth slowdown in the US or other parts of the world, Indian growth should remain stable. And hence, we from a probability standpoint, we expect short-term bonds to outperform long-term bonds.
It's really thought-provoking. Thank you. One last question, Anurag. What kind of fixed income mutual fund one should invest in, given he or she is in the middle of the life stage and considering, let's say, the moderate risk profile?
See, I think typically whenever one invests in fixed income, one is investing for stability and some amount of capital preservation. So that's the first principle whenever is investing in fixed income. So if doesn't matter on the life stage. I think from an asset allocation standpoint, we think moderate duration products offer a much better risk reward because they are not subject to very high volatility when it comes to mark-to-market interest rate risk. Secondly, one should allocate to high credit quality debt products, whether one is investing directly or in mutual funds to ensure stability in their portfolio. So broadly, we think from an allocation standpoint, one should invest in moderate duration because in a kind of in any downturn scenario where they would want their fixed income allocation to provide a counterbalance to their equity allocation, they should have a decent amount of buffer in their fixed income portion. Secondly, even if we consider fixed income more tactically, or in the near term, even the current monetary policy cycle, given that it's a shallow cycle, we think moderate duration is a better bet compared to long duration. So that's largely how we will advise allocation to investors.
Very well answered. Thanks, Anurag. That's all. There are no more questions. We can conclude here.
Thanks a lot, Sandeep. Thank you. Thanks everyone for joining in. Thank you.
Thank you all participants for joining us today. We hope the insights shared by our experts have given you a clearer understanding of current fixed income market, the opportunities ahead, and how can you adjust your investment strategies accordingly. As we know, market is evolving and staying informed is crucial to make sound decisions. We encourage you to continue the conversation and stay connected for the future updates. We truly value your time and participation today and look forward to welcoming you in our next event. Until then, stay informed, stay ahead, and thank you again for your attention. Wish you all a very wonderful evening ahead. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.